Samir Arora, founder, fund manager at Helios Capital, joins in on the show right now. Samir, hi, good morning. First time we are chatting in 2023, so wish you a very healthy, happy, prosperous, and many other adjectives new year.
Profitable. Thank you very much. You and all your companies. Also to Nikunj.
Yes, indeed. Samir, and must say that thank you for the stash of books, being the voracious reader that you are. Thanks for inculcating the same habits and sending us your favorite books.
I'm forcing it down everybody that they should read more.
No, absolutely. Already started yesterday. But tell me, Samir, what's the reading for the year ahead for the market? It's not looking all that hunky-dory, at least to start off with.
I think it's quite okay. I mean, I know the first few weeks have been disappointing, but in general, if US was to settle down and may have already bottomed or may bottom in the next few weeks or months as the interest rates reach the 5% target and inflation doesn't seem to be going out of control. We saw inflation in France, I think 7-8 days ago, and we can see the shipping rates and other things, that inflation may not reach the 2% level so easily, and therefore the Federal Reserve may not cut rates so easily, but the hiking will stop sometime soon, which means at least the market will stop, I think, every day looking at a fall. And if China does well, which I can't believe that the foreign investors are taking that trade so seriously, but for the moment I'm thinking of it more as a rebound trade. But even let's say that China does well in absolute, India should not be negative for just for the fact that China is up, say, at the end of the year 15-20% or even more. So I think if US is not falling and China is doing well, India may underperform China, let's say, for a few months or years or half a year. But I still think that India will in absolute have a reasonably good year this year, which is in the range of, say, 15% type. If you look at, how these cycles move, so the positive years are, say, 5-6, and then 1 or 2 negative years, and in those negative years you will give up the last 2 years of performance mostly. So you are making 4 years of performance in a 7-year period, and sometimes 5 years of performance in a 7-year period, with 1 year being negative and that negative year taking away the returns even of the previous positive year. So that means when the years are positive, the returns are more than average. The average returns are, in India's case, reasonably, to project the similar numbers, 13, 14, 15% per annum. So I think we'll be plus minus that or higher actually by the end of the year.
But to achieve that kind of return, Samir, do you think, unlike what 2021 or 2022 were like, and I'm not even comparing 2020 here, you'll have to bet on different set of horses this year? Would you have to be bullish on a completely different and new set of sectors as opposed to what you did previous year?
No, because there are not very many new sectors in the world. Ultimately, the new sectors was the story of the 90s when we were making 60% per annum for many years, because there were new sectors like Indian IT sector, and then new companies were getting listed. And like, for example, even telecom was a new sector, private media company was a new sector. Now those sectors you can't find every day as in new sectors. So the three big picture themes, if you see where the billionaires come from.
I didn't mean newborn sectors. I mean different sectors than what you did in 2022.
There are no sectors. If you broadly define them, financials worldwide is a big sector, consumer worldwide is a big sector, and IT worldwide is a big sector. And if you look at the Forbes billionaires list to see from where these billionaires come, because they have compounded over years, 80-90% will come from these three sectors. You may once in a while buy one defense stock or you may buy one beaten up stock, but the three sectors of the world are everywhere. It's not that only in India we have these three themes. You can then say, I want this consumer, or I want a low ticket consumer, or I want a consumer durable. Ultimately, there are three themes in the world: financials, consumer, and IT pharma. Everything else is on and off. And there is no history in the other sectors of making long-term returns. And maybe once in a while, some stock will do. But if you look at, in aggregate, very few stocks from outside these three sectors have created long-term wealth.
Hi, morning, Samir. So do you think maybe then these recent additions like Zomato, Paytm within the new age tech space will make you probably get added to one of those billionaire lists yourself?
Well, not me, but those guys are already millionaires. But we own both these stocks. And we bought Paytm when it was down, I guess 75% from the top. And Zomato from the top was down also similar, but from its IPO was down, whatever, one third, 30 odd percent. So now we are betting again on these two having now believing that they are survivors, that their competitors have run out, that the people who were funding the competitors have given up. Because in every the business, whether it was home food delivery or whether it was fintech, there were like 50 startups in fintech and maybe five startups or more in delivery. And those things have run out. So these guys are long-term survivors. And plus the stocks had been beaten up enough. They are not really making losses anymore. If you also consider they both have nearly $1 billion of cash. So let's see. But we are not betting on any one stock to change our life. Our bet has always been, and it has worked quite well all our life, that you buy 20, 25 stocks of this kind, and 7, 10 of the bigger stocks like HDFC Bank. And from these 25, some 10, 15 will do well, 2, 3 will end up doing badly, and the rest will break even relative to the market. But you will not exactly know which one will deliver. For example, last year, how could anybody have imagined that suddenly Varun Beverages, which we own, would be up 100 and some 20%, or Lemon Tree would be up some 70, 80%? You can't know that ahead of time. You broadly are selecting a group of 20 odd stocks and hope that the stats work in your favor, that anyway some 8, 9 have to do well. If you can have 3 extra do well or 3 less do badly, you outperform.
Fair point. But Samir, since you talked about HDFC Bank and we all know your overweight stance on financials and banks, do you need to bet on different horses this time around? Will ICICI Banks move forward, be a little bit challenged? I mean, 2022 FAGAN, you saw suddenly smaller PSBs rising up, along, of course, with SBI. HDFC Bank, Kotak Bank have underperformed. Axis Indocin, yes, are trying their bit, but, far away from the kind of returns that you made on an ICICI Bank and SBI. So again, do you have this cluster kind of approach within banks, or do you bet on specific
Quite a
names?
few banks. We have HDFC Bank, ICICI Bank, and State Bank in nearly the same weight. Actually, technically, right now, HDFC Bank may not even be first, it might have become second. But broadly, they're all 7.5%. And we also own Axis Bank, and we also own IDFC First Bank. So the thing is, we don't own the other state-owned banks because generally we have been uncomfortable all our life with those stocks, and just because they became cheap for a trade, maybe we should have bought it for that trade. But I still don't believe that these companies have got that much freedom. Okay, we can say that they are at a point where NPAs have been written off and all that, but generally we have been for 25 years done well betting against all these things. So by moving towards it would have been a very big change in our mind, and we were not ready and are not ready to do that. But clearly we have a reasonable bet in financials relative to, say, tech. So that is how the financial became so overweight, because we took the view that whatever may happen in IT, it will mostly underperform our market, which it seems to have done, although we didn't get it right. I mean, we didn't sell them all at the top. But from Jan last year, I've been saying, and we reduced some in Jan, but the rest only in July or August. In IT, I mean. And that money was transferred to financials and consumer.
Good morning, Samir. Nantar also joining in. Happy New Year. Yes, you've had zero position in IT, something you've been saying since last year. You've been talking about financials. We spoke a little bit about HDFC, Indocin, etc. But Samir, what I also want to understand, if FIIs are going to be selling left, right, and center, where is it going to leave the financials? And so much has been said towards the end of 2022 that this is the time for the public sector banks as well. We saw the run up in the share price. Did you get tempted? Are you still preferring the private sector lenders?
We have State Bank. That is enough of our bet in favor of PSU banks. But let me say before that, I don't think the FIIs would over a year sell left, right, and center. Just to look at even last year, in the first 6 months, they sold 28 billion of stock, and in the second 6 months, they bought 12 billion. So they, I think, ended the year down 16 billion. But this was only the fourth time in 20 odd years that they sold. Previous years being 2008, 11, and I think 18. So the normal trend for them is to buy. Now, let us say that they today believe that China is having a rebound and therefore they need to increase their weight there. Every year, in any case, they are supposed to put, if they want, to match the index, at least in the emerging market, instance 29 or 28% into China. I can't imagine that they want to right now put more than that 29% and have to sell from India to buy there. This is the fast money, hedge fund type money, which may be running with a fixed amount of capital. But do you really believe that after having seen how in Russia they were marked to zero, not just the portfolio investors, but even corporates had to sell off like McDonald's and British Petroleum and all because of US sanctions. Right now, there is a non-trivial probability that something can happen in China versus Taiwan. If you see just last week, that is in the week of 26 December, some highest number of planes from China went into Taiwanese territory, some 43 planes, you can type and see. And on another day in that week, the Taiwanese government changed the military training for their citizens from 4 months for everybody to 1 year. So this is 1 or 2 weeks ago. I am right now, I haven't told you, but I am right now in Mumbai. And day before yesterday, I saw on CNN that US is talking about war games and how many planes they will lose and how many ships they will lose if there was a fight. And I hope none of this happens. But do you believe that some 5-10 year type investor, pension fund, endowment, not the hedge fund type crowd, will now increase beyond 29% their weight in China if there's even a 10% probability in their mind that it can go to zero if there is a war and the US puts sanctions and forces them to sell or something like that, or that a new company, say an auto company, will now be doing more outsourcing and finding more places from where to outsource in China. I think this cannot be in this situation when all these events are of less than 15-day history. We are not talking about what somebody may have said 1 year ago. If last week the Taiwanese guys are increasing the military training, which you can imagine that the local public would not have liked, that now they have to do 1 year training or 1 year whatever. So these are events. I think we should not worry about Indian money going to China. In the end, I think this will sort itself out. We have to also control ourselves. Like we are now being worried about the budget, that the government will increase taxes and capital gains. If they do that, then that means we are shooting ourselves in the foot and we won't have to blame anybody else. But we know and they know that nobody else in the world taxes foreign investors. Nobody.
Yeah, we always see those theories and news reports about capital gains tax in the run-up to the budget. This year has been no different. Will the central exchequer actually try and disrupt one of the best performing stock markets on this planet? That's the big question, and seems unlikely that's going to happen on 1st of February. Samir Arora, can you tell us recently the big changes you may have made to your portfolio, what you exited, what you entered? We've already talked about the recent additions you made in 2022, which were, of course, Zomato and Paytm.
So these were very recent. I think Paytm was at December only, I think, trade. So it's not very old. And since we overall own about 35 stocks long, every month or so we might change one stock here or there or change the weight. Mostly we are changing the weights in some of these rather than completely new names coming in. We actually bought 2 IPOs also, but very small. And then we bought in the aftermarket, which was this Fusion microfinance and Uniparts. So that also is small. Basically, we haven't done any big changes beyond the biggest sector change, which was IT, which by March, April, we'll see whether we should go back a little bit into it or not.
We didn't know you're in Mumbai. You're dressed to the hilt. You could have made it to our studios even.
When I'm in Singapore, I don't dress to the hilt.
Well, next time we hope to see
know
you
that.
here.
We noticed that the first thing that you're all suited, booted up, and not in your usual.
I wore a green tie. for you. Otherwise, I was
I
planning
wore
on
a
the
green
red track.
jacket. Anyway.
I'm hoping pink of health, hopefully. But anyway, Samir, so, you spoke about the budget and the overall taxes and all, but you don't think that betting on any capex manufacturing theme for the long haul would be beneficial, especially with the budget around the corner and, the expected thrust on that space?
I think more than budget, I don't think budget can do much, but this China plus one is going to be in India's favor. I mean, it may be in other countries' favors also, like Vietnam or Sri Lanka or God knows where, or maybe near shoring to US. But people are going to reduce their exposure to China because they have seen how risky it is to put all their eggs in one basket. The problem in India is that all these companies like Dixon and all these other similar companies, their margins are so low. These businesses, if you see in the world, the Foxconn types, they trade at 8 multiples and 9 multiple. In India, we trade at 30 and 40 multiple. So that is the problem. But at a big picture level, for example, if you see this Apple exports, and they say they have exported $2.5 billion from India already of the new Apple phone, the value added might be less, but so many jobs would have been created, and still somebody would have made some profit also. So the concept will work. Whether we'll find a appropriate stock for it or not, I don't know. But the fact that there'll be more jobs, more assembly jobs, uh, and more jobs for women and all that, because in factories, they may hire. So all that will be all very useful and helpful to India. I'm not sure which stock will be appropriate to play this theme, but India is going to hugely benefit, big picture, from China plus one leading people to India, and maybe to other countries also. We don't care, but as long as some of them come to India, I think they will.
All right, Samir, appreciate you joining in and hope to see you in our studios the next time you're in the Maximum City.
Okay, thank you very much.